Hey everyone, today I want to share with you a tip that might not only improve your investment performance, but also your retirement. Now, I've been seeing a trend a lot lately that I want to make sure everyone in this group can stop before it even begins to become an issue. In the last 5 retirement plans that I've built, this has been an issue in 4 of them. And so this video is titled, Not All Fees Are Created Equal. And I want to take a second to kind of set the stage for this video. So if we rewind 20 years ago, we're sitting at the beginning of 2000. Interest rates were hovering around 5 to 6%, meaning that you could go put your money in a bond, a treasury bond, and earn 5 to 6% on your money. Now, over the last 2 decades, we've seen this interest rate number decline each and every year. And now we're sitting at a point where it's the 10-year treasury bond is earning less than 1%. Now, many of you have taken advantage of this falling interest rates over the years. You've locked in better interest rates on your mortgage or on different debts that you might have. But I often see people forgetting that this interest rate decline affects their portfolio and affects it in a big way. So let's jump into an example and show you exactly what I mean. So on the screen right now, you see kind of a picture of investments that we would be looking at if we were sitting here in 2000, the year 2000. And you see we're comparing a bond fund and a stock fund. Okay, and if we look at this chart, again, interest rates back then were 5 to 6%. And so if we put our money into a bond fund, let's say that we expect a yield of 6% on our money. Now, this bond fund, this hypothetical bond fund that we're invested in, has an investment fund fee of 0.75%. And so if we look at that, we have a 6% yield and we minus out 0.75%, we end up with a net yield of 5.25%. Okay, does that make sense? Now, if we look at a stock fund, if we think that stocks over the long run are going to average 8%, even if we're paying a little higher fee at 1%, you notice that net, we have a higher yield. And so if we're getting an 8% yield from stocks, we're paying a 1% fee, we're netting a 7% yield. Now, this is important to point out that this is why not all fees are created equal. Despite paying 1% in a fee on a stock fund, you still end up with a higher yield net than you would on the bond fund yielding less. But overall, in 2000, this is a much closer gap between stocks and bonds. Let's fast forward 20 years. So today we know that interest rates have fallen significantly. And so let's say this bond fund is now earning 1.5%. You know what hasn't gone down each and every year like interest rates have? Investment fees. And so we're still paying that 0.75% on that bond fund. And if we're earning 1.5% and we're paying away 0.75%, well, we're basically giving away half of our yield here. And so our ending yield only ends up being 0.75%. Now, again, on the stocks, we're still expecting that same 8% long-term growth, paying that 1% fee. And you can see that, again, despite a higher fee on stocks, our overall yield, especially right now, is considerably higher. Now, it's important to point out that we're only comparing the fund fee, okay? Meaning that if you invest in a mutual fund, what that mutual fund costs you. We haven't added in the advisor fee yet. We haven't added in any other fees that you might incur. We haven't added in inflation or taxes or anything like that. So let's say you're paying your advisor 1%. Well, now this bond fund is underwater. You're guaranteed that you're losing 0.25%. But let's jump in an example and show you exactly what I mean. Let's look up some actual funds. Okay, so if we jump in here, I have a few funds listed in the tabs here. A big one that I've been seeing, and a big company in general, is the American Funds Company, okay? And they have a fund, the Bond Fund of America, okay? And let me just get out my annotating tools here. Okay, and notice what we see here. First off, I want to point out that we're looking at a Class A share. So basically what a Class A means is that you paid an upfront sales charge, but your ongoing fee is going to be a little bit lower. And so the ongoing fund fee is 0.61%. Now, if we scroll down here and we look at the 30-day SEC yield, basically what this means is if we look over the last 30 days, what the yield of the bonds in the portfolio got you minus the fee, and then we annualize that. So this is basically showing what you can reasonably expect over the next year from this bond fund. And so we see that after minusing out this 0.61% expense ratio, you're only earning 0.79%. Now this is a Class A share. If we change this and go to a Class C share, and so a Class C would be that you don't pay any upfront sales charge, but you have a higher ongoing expense ratio. We see that the expense ratio goes to 1.36%, and the SEC yield is 0.08%. And so someone investing in this fund is basically saying that I'm all right earning less than 0.1%. But also bonds carry a risk. Like Tony just talked about in the Wealth Wednesday yesterday, bonds carry a risk, they can lose money. And so you're earning almost nothing but have the potential to lose money. You may even be losing money right off the bat after paying your advisor. Now this is the same, even if we go over to Vanguard, and for Vanguard we see that we have a lower expense ratio, but again, because bond funds are yielding so little right now, even with this lower expense ratio, you still end up with just over 1% yielding on your money. Now again, we can go out and get a CD that's yielding higher than 1%. I mean, we can go into PIMCO's Total Return 2 fund, okay? And once again here, we see expense ratio of 0.76%, and we see an SEC yield of just over 1%. Once again, if you're paying an advisor 1%, you're almost making nothing and you have the potential to lose money. Okay, my critical takeaways from this video is make sure that you're reviewing the portfolio and the funds that you might have that could potentially be underwater. Okay, if you're investing in a bond fund and it carries a reasonably high expense ratio, you're likely underwater. And so you might be in a situation where you're already losing money and have the risk of losing even more money as interest rates rise. As Tony talked about last week on the Wealth Wednesday, make sure you're owning ETFs, not mutual funds. Generally, ETFs cost 50 to 80% less than mutual funds and offer the same value to investors. And number 3, be cautious about how bond funds are increasing yields. And so another trend that I've been seeing lately is rather than a bond fund post that you're essentially going to lose money, post that negative yield, what they'll do is they'll take longer duration bonds, or they'll start investing in riskier bonds that carry a higher default rate. And so in order to increase bond yield, they've been basically moving to less preferred bonds. Okay. And so yes, that does increase your yield, but it also increases your potential of loss. And so hopefully this video was educational, provided you a little bit more insight to always be focusing on expenses as much as you focus on the amount that you can gain from that fund. Always remember, you don't need more money, you need a better plan. Thanks for watching today.